tax for the income. Is income? What are tax slabs? Let's start with what is income tax. Income tax is the tax which is levied by the government of India on anybody who earns income in India. By anybody we mean individuals, Hindu undivided family, firms, companies, etc. Whether you are a resident of India or a non-resident of India or NRI. It is imposed on the basis of an act called as the Income Tax Act, which was passed by the Parliament of India in 1961. Tax is for a period of the income earned. It is not a lifetime tax. Income earned in the 12 months in the period from 1st April to 31st March of the next year which is commonly called as a financial year or the previous year. Income earned in the financial year is assessed in the next financial year, which is called as the assessment year. So, for the income earned between 1st April 2012 to 31st March 2013, called as the financial year 2012-13, or the assessment year 2013 and 14, for the income that you earned from 1st April 2013 to 31st March 2014, that is the financial year 2013-14 or the assessment year 2014-15. The income earned in the financial year 2013-14 will be assessed for the income earned in the financial year 2012-13. You would need to file your income tax return by 31st of July 2014. Let's start with what is income. Income is divided into 5 categories. First one is income from salary. This is the category of income which comes only when there is an employer-employee relationship between the payer and the payee. So typically when you have working under someone and you get the income because you're working under someone, it is comes under this category. You get a Form 16 as a proof that you have earned income from salary. This income from house property, any residential or commercial property that you own, is taxed. Even if your property is not let out, it will be considered earning rental income and you need to pay tax on it. If you have a home loan, then interest part of it would be considered as a negative income from house property. Then there's income from business or profession, which is chargeable when there's a difference between the money that you earned on running the business and the expenses incurred. There is also income from capital gains, which is any profit or gain arising from the transfer of capital asset which is held as investment, something like house, jewelry, mutual funds like gold ETF or the debt mutual funds. These gains are categorized into 2, short-term funds and the long-term capital gains. The difference between the two is the amount of time for which you held that investment product. For example, income tax from the selling of a house comes under the long-term capital gain only if you have held the house for more than 3 years. But for a debt mutual fund, when you have held the debt mutual fund for more than a year, it comes under the category of long-term capital gains. And the income which does not fall in any of the above categories come under income from other sources. Examples are the interest, income from bank deposit, winning from lottery, any sum of money that you have received as gift, more than 50,000, which is other than relative or marriage or will and inheritance. Total income that is chargeable for income tax is a sum of all the income under these categories. How much tax does one pay? Income tax depends on the tax earned. More the income, more the tax. So not everyone has to pay the same amount of tax. The income also varies with the age. So they are divided into less than 60 years of age, between 60 to 80 years called senior citizens, and more than 80 years which are called very senior citizens. It is also based on the residence, whether you are a resident of India or a non-resident of India, whether you are male or female, and it depends on the financial year. Every financial year during budget, the finance minister comes out with some special sections for the income tax under which the income can be exempted or deducted. So, the income tax that is levied varies also on the financial year. For example, in 2010-11 financial year, there was a income tax under 80CCC where you could invest 10,000 rupees and claim that deduction, but that was taken off. But in the year 2012-13, the section 80TTA was introduced where the interest on the saving bank account up to 10,000 rupees was exempted. These examples we'll take up in the later sections. So, depending upon how much you earn, the income is categorized into various slabs. Income tax slabs for the financial year 2012-13. That means for the income earned between the 1st April 2012 to 31st March 2013, the slabs were as follows. For male and female less than 60 years of age up to 2 lakhs of income earned, there is no income tax. From 2 lakhs 1 to 5 lakh, there is an income tax of 10%. From 5 lakh 1 to 10 lakh, there is an income tax of 20%. And above 10 lakh, there is a tax of 30%. What they exactly mean, we will look in the later slides, so just bear with me for a few seconds. For resident individuals of 60 years or above, up to 2,50,000, there is no income tax. From 2,50,001 to 5 lakh, the income tax charged is 10%. From 5 lakh 1 to 10 lakh, it is 20%, and above 10 lakhs is 30%. And similarly, there are tax slabs for the very senior citizens, those who are of 80 years or above. The income tax slabs for the financial year 2013 or the assessment year 2014-15 are as follows. There's a basic exemption for men and women up to 2 lakhs. For senior citizen, it is up to 2,50,000, and for very senior citizens, it is up to 5 lakhs. If you have income from 2 lakh 1 to 5 lakh, you will be paying income tax of 10% if you are less than 60 years of age. And over and above this, you pay what is called as a surcharge. But this only is applicable if your total income is more than 1 crore. And then is education cess, which is 3% on the income tax plus a surcharge. The question is how to calculate income tax. Where the total income does not exceed 2 lakh rupees, you have to pay 0% tax. Where the total income is between 2 lakhs to 5 lakhs, you have to pay 10% of the amount which exceeds 2 lakh. So, if the total income between 5 lakhs to 10 lakhs, you have to pay 30,000 plus 20% of the amount which exceeds 5 lakh. Where the total income exceeds 10 lakhs, you have to pay 1,30,000 plus 30% of the amount which exceeds rupees 10 lakh. Education cess is at 10%, 2% of tax, and secondary and higher education cess is at 1% of the tax. It is calculated, or total is 3% of the tax, not of the income. Let's look at some example. Suppose a person earns an income of 6 lakhs. So, based on the income tax slabs, the income tax calculation will be as follows. For the income above 2 lakhs, you would have to pay 10% of the tax. So on 3 lakhs, he pays 30,000. For income above 5 lakhs, that is 6 lakhs minus 5 lakhs, that is 1 lakh, he will pay 20% of the tax, that is 20,000. So the total tax that an Indian male less than 60 years pays on earning a total income of 6 lakhs is 30,000 plus 20,000 plus 3% of the tax. Remember, it is 3% of the tax and not in the income. So the total tax becomes 50,000 plus 1,500, which is equal to 51,500. If a person has a total income of less than 2 lakhs, then he does not have to pay any tax on it. So, for a 10% income slab, there's a total income of say 4 lakhs. His taxable income is 4 lakh. His income slab is 10%. Tax on an income is 10% of his income which exceeds the basic assumption, for which financial year 2012-13 is 2 lakhs. So it is 10% of 2 lakhs, which is 20,000. On this, he needs to pay a surcharge of 0% as his income is less than 1 crore, and education cess of 3%. So 3% of 20,000 is 600. So total tax that a person earning an income of 4 lakh is liable to pay is 20,600. The 20% tax slab is an income of 8 lakhs. It is similar to what we had dealt in example of 6 lakhs. One is the 30,000, that is 10% of 3 lakhs. 60,000, that is 20% of 3 lakhs, which is 90,000. The other way of calculating it is 30,000 plus the 20% of his income which exceeds 5 lakhs. On this, he needs to pay a surcharge of 0% and an education cess of 3%. So, earning an income of 8 lakhs would be liable to pay a tax of 92,700. For a person who is earning an income of 14 lakhs, will come under a 30% tax slab. For the first 2 lakhs, he gets exemption and pays nothing. Next 3 lakh, he pays 10%. On next 5 lakhs, he pays 20%, and remaining 4 lakhs, that is the amount which exceeds 10 lakhs, he pays 30%. So, the total tax that he pays on an income of 14 lakh is 2,50,000. Other way of calculating is 1,30,000 plus 30% of his income exceeding 10 lakh. On this, he pays a surcharge of 0% and education cess less of 3%, that is 3% of 2,50,000. Tax slabs in India over the years have changed. From 1949 to 1950, the exemption limit was of 1,500, and there were 4 tax rates, where the entry rate was 4.69 and maximum was 25%. In the year 1970-74, the exemption limit was 5,000, but the number of tax rates were 11. And over the period of time, the tax slabs have come down, and since 1995-96, there have been 3 tax slabs of 10%, 20% and 30%. With the exemption limits changing over the years, and also the maximum rate of income tax. Let's see how the income tax rate of India compares with the income tax rate around the world. Around the world, if you look at this, we're paying somewhere in the middle. There are countries where there are taxes of more than 51 to 60%, and yes, there are countries where you pay a tax of 0 to 10%. Comparing income tax rates with the world, India is somewhere in the middle. There are countries like Belgium where there are more taxes, and there are countries like Canada where the taxes are negligible or less. If you need more information on income tax, you can contact bemoneyaware.com by dropping an email at bemoneyaware.com. You can check out our blog and also our website, where these articles are arranged in a chronological order. Thank you. Thanks for giving us a time to listen to the basics of income tax, especially on the income tax slab. I hope you enjoyed it.